And welcome to this episode of the Bull and the Bear podcast. I'm Matt Clark. Glad you're with us with moneymarkets.com. Today we're going to take a track. Normally, I don't necessarily like to get into famous people, although my guest is famous in his own right. But we'll get into that later. Before I get too off track here, I just want to remind everyone that you can listen to the Bull and the Bear on Apple Podcasts. You can listen to us on Google Podcast. You can listen to us on Spotify. We're also on iHeartRadio and a bevy of other podcast syndicators out there. So please go on there, give us a review, give us a ranking, let us know what you think. If you have any questions, comments, or anything like that, maybe it's something you'd like us to dive into, make sure you email us at thebullandbear@moneyandmarkets.com. Thebullandbear@moneyandmarkets.com. More than happy to check out your feedback there as well. Now, anyway, to get back on track, I don't really like to talk about famous people just because, they already get enough press as it is and there's no sense. But what we're going to talk about today is a little bit different in terms of the investing world. When this individual speaks as an investor, you stand up and you listen. And you listen well. I mean, you drop everything to listen to what this individual has to say. And for good reason. Just in looking at the math, this individual has had a total return since the 60s of almost 2,000,000%. And that's million with an M. Which is awfully impressive. And he's got a system that he works and it does well for him. I mean, just like any investor, there's ups and downs. They're not all winners. They never will be, but this individual has way more winners than he has had losers. And the person I'm talking about is the Oracle of Omaha, Warren Buffett. Great guy, by the way. Very humble, very down to earth. He's got that Midwestern feel, that Midwestern mentality. Doesn't really brag on himself. In fact, doesn't brag on himself at all. Doesn't brag on himself. Doesn't brag on his companies. He's just not that kind of person. Not an ego to be found. But he carries a lot of weight in the investment world. Whether you are just a regular investor, whether you are more savvy or a day trader or companies stand up and take note of what Berkshire Hathaway is holding. They want to know what is Berkshire Hathaway betting money on, because when Berkshire Hathaway bets money based on what Warren Buffett says, Berkshire Hathaway by and large makes a lot of money. And there's no denying that. And as an investor, let's be honest, that's what we're here for. We want to make money. We're not just doing it for fun. It's not a not-for-profit sport. So that's what we do. But what I want to talk about today is to drill in a little deeper, because everyone likes to try to guess where big bond traders and big investors, how they come up with their methodology and how they determine what to do, what not to do, when to sell, when to buy, when just to hold steady and not do anything. And Warren Buffett is one of those. I mean, a lot of people try to guess, okay, what is he doing? How is he doing it? Because you always want to try to get an edge and try to get ahead of the game and figure if you've got that edge, then you can trade in advance and make big gains. Not always the case, but there's some insight into that, into what Warren Buffett does and how Warren Buffett performs and how he makes his money and how he makes his company a lot of money. And I want to bring in Money Markets contributor Charles Sizemore because he had a very interesting piece on the Buffett Indicator, and I'm not sure if that's something you coined or if that's a generally known title, but I guess I want to bring you in because you have a very compelling article about the indicator and how, what it's used for and how he uses it. I really want to drill into that. So first off, welcome, and second off, let's talk about the Buffett Indicator. What exactly is it?
Sure. Well, thanks for having me. So the Buffett Indicator, I did not coin that per se. I have heard others refer to it. It is a quick and dirty metric that Warren Buffett uses to judge the broad market's valuation. So Buffett, of course, is not a market timer. His whole shtick is he buys good companies at reasonable prices, or is he speaks with a little more hyperbole, fantastic businesses at reasonable prices. He's not necessarily a hard-nosed value guy in that he demands they be just dirt cheap. Young Warren Buffett was like that, actually. Older Warren Buffett, when talking about the younger Warren Buffett, says, in my youth, I used to go for cigar butts. I would find something that had, a few last puffs in it and then discard it. He'd buy deep value, ride it a little higher and get rid of it. As he got bigger, that just wasn't a viable strategy for him anymore. And he saw, look, if I want to really take advantage of longer term trends, I need to find really good businesses at good prices, reasonable prices, not even necessarily cheap, just reasonable, right. And ride them. And so that's been his mantra is the wrong word. That's been his methodology.
Yeah, that's his MO.
Yeah, Buffett. It's funny. Most people don't know this, but prior there was a Warren Buffett before Berkshire Hathaway. Warren Buffett actually had a hedge fund. They didn't call them hedge funds back then. It was just a private investment partnership. But back in the 50s, Buffett killed it. He ran a small hedge fund and just smashed the returns. The returns they're not publicly available. You have to look around, but they were upwards of 30% a year for a good stretch.
Wow.
So Buffett killed it when he ran a much smaller fund. Now, what happened was he in the late 50s, early 60s. Wow, time goes. I can't remember exactly when it was. Buffett was not happy with market valuation, so he ended up closing his fund and returning money to investors. And then what was left over, he traded for himself. That's how he sort of accidentally ended up with Berkshire Hathaway. He was trading Berkshire Hathaway stock. He actually had a methodology on this. He noticed that the board of directors would issue a tender offer every couple months, every quarter, whatever it was, offering to buy back the stock at a pre-specified price. So he knew that was going to happen. So he would get in front of that trade. He would buy up some Berkshire Hathaway, which at the time was not an insurance company. It was a failing textile mill.
Yeah, it was a textile company. Right.
Exactly, and it was not doing well. So Buffett was kind of doing his old cigar, cigar butt investing. Buying this cheap stock, riding it for a little bit, and selling it for a little bit more. What happened was, he got used to his quarterly call where the chairman would call him up and say, Mr. Buffett, I understand you own some shares. We would like to tender those from you. We'll buy them for whatever the price was, $10 a share, or, $9.50, whatever it was.
Right.
And Buffett would say, okay, send me the paperwork. We'll get it done. Well, they agreed to whatever the figure was. I don't remember. Let's call it $10 a share. And when Buffett got the offer in the mail, it was $9.75. And you think like the older, wiser, gentlemanly Warren Buffett would just kind of whatever. This was the young hothead Warren Buffett. It's hard to imagine that, but he was not always this age-old man. He used to be, like the rest of us. He had a temper at some point, and he was so enraged by the fact that they tried to gyp him by a quarter a share or whatever that was. But they tried to gyp him. They didn't. They sent the offer for less than what they agreed.
Right.
He ended up buying a controlling interest in Berkshire Hathaway, so he would have the pleasure of firing that guy.
Wow, that's quite a story. That's interesting.
It's hard to believe that because you see Buffett now as this gentlemanly old man. But anyway, he so then he's like, I got that guy. Oh, now what?
Now you own a company.
I'm stuck with a company that's a disaster. So anyway, he ended up wasting, a couple of decades of his life trying to kind of make Berkshire Hathaway work in its original format. It ultimately failed. It's no longer a textile company for obvious reasons. And Buffett transformed it into the financial powerhouse it is now by buying insurance companies and things like that. But it's funny, if you ask Buffett, and Becky Quick of CNBC did ask Buffett this. She said, Mr. Buffett, what is the worst investment mistake you've ever made in your career? And he said, without even flinching, without hesitating, buying Berkshire Hathaway.
Buying Berkshire Hathaway, yeah.
Said, and if I could do it all over again, I would have skipped Berkshire Hathaway, never touched that thing, and I would have just bought Geico instead because Geico was his next major purchase.
Right.
And that's really what built the Buffett empire, was investing the insurance float from Geico. So anyway, he's like, yep, I would be twice as rich as I am today if I had never touched Berkshire Hathaway and gone directly to Geico. And he's a very wealthy man, so to say he'd be twice as rich is a strong statement. But getting back to the Buffett indicator. So what is that? So but again, Buffett doesn't time the market. He buys individual stocks, but he does like to know the environment he's in. And so his sort of quick and dirty analysis of where market valuation stands, he compares the market cap of the entire stock market. You can measure that different ways, whether we're talking S&P 500, Wilshire 5000. That's not that important, but he compares the stock market, the size of the overall market, to the size of the economy, to GDP. And over time, the two should move more or less together. Obviously, stocks are a more leveraged bet on the economy. It's not always one-to-one. But what Buffett looks for is this indicator getting out of whack. If stocks are disproportionately valuable relative to the economy, or much lower than usual relative to the economy, he would see that as overpriced or underpriced.
Right.
Well, so backing up for a minute, if you recall when the world was ending a few months ago, it seems like at this point a lifetime ago, but the world was on fire back in March. And everyone assumed the value investors like Buffett would ride in like the Lone Ranger and just start buying aggressively.
Right.
But
it didn't happen. Didn't happen.
He did not at all. In fact, he actually used the strength at the end of March and beginning of April to dump a lot of his existing positions. He actually lightened up on stocks.
Right.
And you ask, well, why? What was it that Buffett saw? Well, if you look at this indicator, this market cap to GDP indicator, at the lowest it got in March, like the depths of March, it was still higher than the pre-2008 high. So like before the world blew up in 2008, stocks had gone up for 4.5 years. That ratio was back at pre-2008 blow up levels.
Wow.
So, today the market cap of the Wilshire Total Market Index is about 150 times GDP. Now, it's actually going to be higher than that because, as you know, GDP is in free fall at the moment still.
Right.
And that is not reflected in the numbers yet. That's a lagging, that we don't get data for GDP for months after the fact. So it's actually going to be higher than what that indicator suggests. At the lowest point in the recent sell-off, it got down into the 120s range, but that's still very, very high by historical standards. To put that in context, in early 2009, after the 2008 meltdown had just ripped through everything, and when things finally bottomed out there in the first quarter of 2009, the index was at 50.
And it's at 120 now.
It's at 150 now.
150 now.
Exactly. So, and it was at 120-ish at the lowest point in March. So, we're talking like, the lowest point in this recent sell-off never got anywhere near the sort of generational buying opportunity we saw in 2008, 2009. I mean, it was more than double. And, this is not just a single data point. If you look at the data stream on that, it's, one thing you will notice is overall, stocks have become a bigger piece, have become bigger relative to GDP. Like that is a long-term secular trend, and that very well might continue. There's no set in stone reason why the total value of the market cap has to be less than or more than GDP. Right. But again, what you're looking for is it massively out of proportion to historical norms? And in this case, the answer is yes. It had been trending higher for decades, and then kaboom, it shot to the moon post 2008. And so that's the Buffett indicator. You're asking, why is Buffett not buying? I don't pretend to read Mr. Buffett's mind, but I don't have that Vulcan mind meld thing going. I wish I did. But we can presume based on Buffett's past interviews that this is a major reason why he's not investing.
So in layman's terms, what we're looking at right now, just using this one indicator, let's preface by saying, there are many indicators out there that you can use to determine whether it's time to buy or time not to buy or whatever. But what this indicator itself is, and what Warren Buffett uses as kind of a precursor to decide what he's going to do with the Berkshire Hathaway portfolio, suggests now that the market is extremely overvalued, especially compared to GDP.
Exactly.
And as GDP continues to fall, and it's likely that it will, because as you said, it's a lagging indicator. Right now we're in the second quarter. We only have first quarter GDP, hard numbers at this point. We won't get second quarter GDP numbers for another month or two, I don't think. So we don't even know the depths of this. We know that Fed Chair Jerome Powell followed up the Fed meeting on Wednesday by suggesting that Fed perceives the economic impacts of the coronavirus to be long-lasting, not just a one-off, real quick type of a thing, but it's going to last for a while. That would suggest that GDP, is going to continue to fall. How long, how far, how fast, it's anybody's guess. But let's just say, for the sake of argument, second quarter GDP is going to be down. Third quarter GDP possibly up, but not nearly as high as where it needs to be. Fourth quarter GDP could be around the same. Who knows? But again, to wrap all this into a layman's terms, according to this particular indicator, the market is extremely overvalued. There's a lot of companies out there that are priced way higher than where they should be. Now, the rationale for that is something that I don't think any of us really understand, just because this market is not behaving in a traditional manner. Now, again, we've said it before, the stock market is not the economy, and the economy is not the stock market. So to suggest that if stocks are up, the economy is good, or stocks are down, the economy is bad, that's kind of a misnomer. It's not necessarily how it works. But if you are comparing the two segments, the GDP and the stock market, I think you're right. There should be some level of some kind of uniformity, either moving up or moving down. Not a vast difference. And that's what we're
seeing. To be clear, this is a quick and dirty measurement. It's not like Warren Buffett is, there with a financial calculator, getting it to the penny. I mean, that's not how he invests. It's never how he's invested.
Yeah, this is a very broad look at the entire market compared to the entire GDP. It's not drilling down to a sector. It's not drilling down to this. It is a broad look at the overall market, not, and that's how it should be viewed. It's a very much a top-down kind of a look, and then from there you drill down even further. But again, what this indicates is that we're in a market now that is extremely overvalued compared to GDP.
Well, what it comes down to is one of Buffett's favorite terms is margin of safety, because he knows it's a mistake to be overly precise. And there was a great quote on. I'm going to butcher this, but John Maynard Keynes had an interesting quote on. He said, "I would rather be generally right than precisely wrong."
Right.
And people associate Keynes as being kind of a socialist or whatever, and he kind of was, but he was actually a stock trader. And apart from being an academic economist, he was actually a successful stock trader. For people don't know that, but anyway, his comment that I would rather be generally right than precisely wrong. Well, that's how Buffett views this. It's a mistake. If anyone who knows something about stock valuation, how do you value a stock? Well, you can use a discounted cash flow model where you model out what their sales are going to be and their profits going to be years in the future, and you assign a discount rate, which is based on market interest rates plus a premium factor in there. Well, if you adjust that discount rate by 0.5% or 0.25%, it can cause the stock price to go up or down, like your theoretical stock price to go up or down by half or something crazy. So it is a mistake to try to be overly precise in any sort of market valuation, because very, very small changes in your assumptions have huge impacts. So that comes back to Buffett's margin of safety. You don't need it to be exactly precise. You just need it to be generally a guiding principle, basically. And that's where we are. Now, there's always some caveats. It's never different this time, but it's always a little bit different this time. There are a few reasons why the market should be more expensive than the past. Number one being interest rates are at zero. When you have a low interest rate environment, asset prices assets that are priced based on those low interest rates should be higher.
Right.
That's how that works. Beyond that, you also have the Fed aggressively pumping money into the system. That also pushes things higher. And then finally, the composition of the market changes over time. And today, the S&P 500, for example, it's completely loaded with tech companies, which tend to be higher margin. Mm-hmm. All else equal, these higher margin companies should have higher valuations than an electric utility or something.
Right.
All of that said, all that's fine. Those are all very valid arguments. But do they give you that margin of safety that would justify this level of overvaluation? And I would say probably not. I think you can make a big quantum leap stretch and say that stocks are maybe fairly valued, but that's a stretch. I think, it's also probably not fair to say, no, like they're just the most expensive they've ever been in history. That's probably not quite fair either because of these caveats. But I would say it's fair to say you don't have much of a margin of safety right now. This is a more expensive than usual market. It is a riskier than usual market. You do need to take that into consideration before you put a single dollar into this.
And that leads me into my next question, and that is, if I'm an investor and I'm looking at this and I see the news and I see, I read your piece and hear you talk about the Buffett Indicator and how it would appear that based on this metric that the stock market is overvalued. Now, whether that doesn't necessarily drill down to a specific company, but by and large, the entire market is overvalued. As an investor, how should I take that news? What should I do with that news, with that information?
Sure. It's to use a baseball analogy, and I still hold out hope that we may get baseball this year. Something on sports of some kind. I'm just
right.
I think I told you this before. I actually found myself watching South Korean baseball the other day because I was just so starved for sports. There was nothing else on.
I understand completely.
Use a baseball analogy. You wait for that fat pitch. If you want to swing for the fences and knock it out of the park, you wait for the fat pitch. You don't go swing at every curveball. You wait for that one down the pipe. And this is not that moment. That doesn't mean you need to be completely out of stocks, but it does mean this is not a time to be overly allocated. Let's just throw out some numbers. If 60-40 is kind of the baseline allocation that, they recommend, the financial planners, what have you, 60% stocks, 40% bonds. If that's sort of the baseline. There are times when you should say, okay, but stocks are cheap, so I'm going to push that needle. I'm going to go 80% in stocks or 100, whatever. I mean, I might take out a margin loan and go 120% in stocks.
Right.
Please don't do that. But you get my point. There are times where it makes sense to be overweighted relative to your normal allocation based on valuations, based on the situation. There's that fat pitch. You got to swing for it. But there are times where it makes sense to be underweighted as well. And a time like this, when markets are at this level, you probably want to have some skin in the game. I mean, this market has, Thursday's action notwithstanding, this market has a lot of momentum behind it. It makes sense to have some skin in that game. It does not make sense to be fully invested. If your normal allocation is 60-40, maybe you should be 50-50, maybe 40-60. Depends on when you need money.
Is this a situation where obviously maybe more cash in the portfolio is beneficial?
Well, more cash, and I would also argue, that part that you would normally have in bonds, I would keep that, if not in cash, at least in shorter dated bonds, because with bond yields where they are now, it's not to say yields can't go lower. Yields can go negative. Who knows? But
sure.
That's not likely. And that big move in longer term yields has already happened. Remember, yield down, price up, price down, yield up. That's the way bond valuations work.
Right.
They actually do make trainees in a lot of investment banking programs put their arms out and do the airplane thing for. They'll never forget it. I mean, that's something you never forget when you have to get up in a room and do that. But anyway, with yields as low as they are now, the big movement in price and bonds has already happened. If anything, you are taking risk to keep a long dated bond portfolio. To keep it long dated, it makes a lot more sense to keep your bond portfolio closer to cash. 1 to 5 years maturity at most. But you're not really getting a lot more yield if you go further out on the curve right now, but you are taking more risk. So keep more cash on the sidelines, just in case. Keep your bond allocation a little bit shorter term. Keep some stocks. Keep some in stocks. I mean, at the end of the day, this market does have a lot of momentum, but this is not a time to go in big. This is a time for small ball, if you will. I would also say, have a plan. Know when you're going to get out. Know if you're going to get out. You may have some positions that you're comfortable holding through a bear market. Maybe they're good dividend payers or whatever. Right? But you may have a handful of stocks that you're like, yep, If they fall 50%, I don't care. They'll come back. I'm not worried about it.
Right.
Fine.
You love the company. You're in it for the long haul. And,
Sure. And
market
if that's your
fluctuations.
situation with those stocks, then by all means, carve those out, and those are your long-term picks. But if you have others that you're less committed to, then know when you're going to sell them. Have a plan for that.
So the overarching thing here is this is not necessarily a time to be completely out of the market. It's certainly not a time to be completely in the market. You just kind of have to do your homework and figure out what is the best methodology for you. And you can use the Buffett Indicator as a way to kind of judge.
Well, to add into that, what is Buffett himself doing? Buffett didn't sell everything.
No.
But Berkshire Hathaway is sitting on, I can't remember the number exactly. It's something like a third of its market cap is cash right now.
Right.
But that means he still has plenty invested. So, if you want to take a play out of Buffett's book, keep the stocks you believe in, ride those higher, but keep some cash on the sidelines too.
Good advice. Good advice. We're going to close it up right there. Charles Sizemore, appreciate the time and appreciate you coming on today. And always a pleasure to have you on every week. So thanks for coming on, and we'll look forward to talking to you next time. Again, Money Markets, the Bull and the Bear podcast on moneymarkets.com. You can check us out on iTunes, Apple Podcasts rather, Google Podcasts, Spotify, iHeartRadio. Whatever your syndication choice is, you can check us out on YouTube. If you're watching this on video, we do have a YouTube channel if you know already. But by all means, go to youtube.com and you can do a search for the Bull and the Bear podcast. Find us, subscribe, get alerted every time we put out a new video of any kind, whether it's the podcast or we're working on a Money Markets 101 series to kind of outline some of the intricacies of the market and give you kind of a clear, concise definition of what those are. A lot of other things, coming down the road as well. So make sure you jump in on that. So subscribe in whatever method works for you, YouTube or audio or however. Check us out at moneymarkets.com as well. And would love to hear from you. The Bull and Bear at moneymarkets.com is our email address. Hit us up. Let us know if there's maybe a topic you'd like me to pick Charles's brain about, or Adam O'Dell, Chief Investment Strategist for Money Markets, or anyone else. We'd love to hear that. Leave us a review. Leave us some comments anytime. We do appreciate that. So for Charles Sizemore, I am Matt Clark. Glad you're listening to us on this edition of the Bull and the Bear podcast. And until next time, safe trading.